Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, Senior Technical Analyst with Market Rebellion. And before we get into the charts, I just want to make sure you understand the importance of risk management. Why am I stressing that so much and so often? Well, in 2000, I watched people literally destroy themselves, not just financially and emotionally, but personally. I've watched people destroy their entire fortunes, their retirements, in a matter of months. And then what happened after that, we had the crash of 2008, where it just wasn't a real estate bubble, it was another market bubble. And again, I saw that repeat performance of the market taking assets from folks that I was dealing with at the time. And I was putting out warnings in 2000, I called the top. 2007, I called the top. In 2021, January 19th to be exact, I called the end of the greatest bull market in the history of the markets. And while I continue to hold my long-term bearish stance, there's a good reason why I do that. I'm out to try to put the warning out for people just to make sure that they are protecting themselves with any long positions and not getting caught up into the hype of the markets. So we have a lot of things going on geopolitically and market-wise, and I just want to point those out to you. First and foremost, let's take a look at the diamonds. This is a daily chart of the diamonds, and as you can see right here, we have a bearish harami right there. We closed that on lower volume. Now again, take out your trading checklist. I have a 7-point trading checklist that is available through Market Rebellion. You may have seen that video on YouTube go out. But basically all I am doing is I'm weighing the evidence. I tell people, draw a little cross on a piece of paper or whatever it may be. Look at the buy signals versus the sell signals. That bearish harami is a bearish signal. 80% of the time, after you see a bearish harami or a bearish engulfing, you generally see markets drop. Look, there's a bearish harami right there. Took about 5 days, and then what happened? We had a sell-off. And interestingly enough, this was a back-to-back bearish harami condition. And right now, we have a similar setup right there. There's the bearish harami. So that is bearish on your checklist. We have a drop in volume on the way up. That is bearish. We have a wide divergence from that 20-period moving average. That is bearish. We have gaps below the market here and a gap filled support level right there. That is bearish. And the oscillators are crossing with sell signals here and here. Bearish and bearish again. Now, let me draw your eyes again down to that CCI. Here on the price, we had a higher price level, but down on the CCI, we have lower highs. That is a negative divergence. And I'll be pointing that out consistently as a warning to folks that you have to make sure that when those negative divergences show up, the markets tend to sell off, and they sell off pretty hard. Look, back here, same scenario. Higher highs right there on price, but we had lower highs on the CCI. And then what happened? Boom, right there. We had another situation where we had a higher high right there, and we had a lower high on the CCI. And what happened after that? Again, it continues to sell off. Now, the negative divergences are not trigger points. They're warning flags. The trigger points are usually found in the candle itself alongside volume as a confirmation indicator. So I am not moving my downside target. That downside target is still in place from last week, right there at 330.56. I know I do get comments from people who are day traders. Understand, I am not catering to day traders. So if you tell me, oh, you didn't hit the target this week, you're missing the whole point. This is for swing traders and option traders. That target right there of 330.56, and you'll notice that there's a box on the right-hand side that gives you a date. The date is not as important as the price target. That is giving our option traders an idea of where to set up their spreads, where support levels might be, where resistance levels might be. So if you're a day trader, this report may not be for you. It could help at least get a direction, but I'm not promoting day trading. I think it's highly risky. You don't have order flow to back your positions up, and it's not a high probability strategy. So I'm just pointing that out again as a risk management note. So that is DIA. If we look at IWM, you will see that we closed with a bearish engulfing. Now, this is different than a bearish harami where the red body is engulfing the previous green body. Now, the reason this is so interesting is because we have a lineup here, a bearish engulfing candle here from Wednesday, another bearish engulfing candle here on Friday, right at a resistance point here. And so while we did hit my upside target on IWM from last week, my downside target has not hit yet. That downside target right there is still in place at 171.82. Again, taking out your trading checklist, you could see that we have hinging going on the stochastic. We have a pivot here on the CCI. We have an open gap below the market. Again, more bearish signals than bullish. Therefore, I'm leaving that downside target in place. That's IWM. If we look at the Qs, this basically is the ETF for the tech sector. We are stuck at a resistance point right here. We've kind of done a lot of sideways action, and that's about it. On Wednesday, we came close to moving below that 20-period moving average and close to that target right there of 309.77. That target, again, is remaining in place, not changing at all. I think that we could hit that on Monday or Tuesday, but don't hold me to the date. Hold me to the target. Again, upside resistance is up there around 323.33. Now, if we move along to the S&P 500 ETF, this is also known as the spiders. Again, another bearish harami. Look at that. Little baby red-bodied candle falling within the longer red-bodied candle. We have a drop in volume on the way up. We do have a higher high, higher low today, but it's on lower volume. And we have another negative divergence, not just in the CCI with lower highs on the CCI, but we have another negative divergence on the stochastic. Again, higher price highs followed by lower highs on the oscillators is a warning flag that basically tells us watch out below. We have a gap below the market, wide divergence from the moving average. Again, taking out your trading checklist, you can see that there's a lot more bearish signals than bullish ones. Therefore, that target is still in place from last week at 401.73. Now, looking at the VIX, this is very interesting because it took a few days for me to even hit the downside target. Not only did we hit that downside target of 1810, but we are now down around 17 on the VIX. Now, this is extremely bearish for the general markets because if you look at the VIX, this is the lowest reading we've had in over a year. Not only that, but if you look at the CCI down below, that's the second lowest reading on the VIX. While I cannot give you a guarantee that the VIX will rally, I could always give you guarantees on gap fills. I can't give you a guarantee it's going to rally. I will say this, there's a 99.9% chance we will rally next week in the VIX. My upside target is up here at 2120. After we hit that target, and I feel confident that we will, then the moving average will act as support, and we'll have more or less a step up of that support level, and then we'll have to see how much higher the VIX will go from there. Now, again, going to the geopolitical news, I'm telling you right now, my opinion here now, right? This is my opinion. You don't have to buy into my opinion. You don't have to agree with it. You could most certainly disagree with it. But I believe that the banking crisis is not over yet. Here's why. Small banks and regional banks, as well as the big banks, rely on loaning money out to make money. That's their model. If they're not loaning money, they're not making money. Earnings are going to suffer. If depositors are pulling money out of the banks, then they have less working capital on their balance sheets. Think of it as your margin account, right? If you don't have enough margin in your trading account to make a trade, your broker will not let you make the trade. So the regulators require more or less that the banks have a margin before they can loan out money. So we have a credit crunch here. Notice this graph at the very bottom. This is a 2-week change in loans. In other words, there is a lack of loans going out. There's a very dramatic drop in the amount of loans that are being issued. And this is the biggest weekly drop in 8 years. Again, the banking crisis, in my opinion, is not yet over. Now, looking at some more data, this is jobless claims. This is something that came out by Bloomberg earlier this week. The percentage of continuing claims has never hit this level right here. See where the red circle is? It's never hit that level and then gone down from there. It's always gone up to much higher levels. This will be one of the first times that this has happened in such close proximity to the last move higher. Again, this was the COVID crash, and within a 3-year period, we are right back into what could be another big spike in jobless claims. That is not good for the economy. Keep that in mind. We're looking at the numbers as the data hits the street. And I had one gentleman on the Q&A or the comment field in the YouTube page said, are you being driven more by the geopolitical news than the charts? My answer to that is you have to look at both. It's like when I was talking about projecting the weather or forecasting the weather. You could look at your barometer, you could look at your thermometer, you could look at isobars and look at the change of pressures from one region to the next. But if you're not looking out on the horizon for the big storm that's spinning out in the Gulf of Mexico, you could wind up being devastated by a hurricane because you're not prepared for it. That's the reason why we go into the geopolitical picture, to look at what's happening on the horizon. Then we connect the dots and we see how that will affect the markets. For almost a year, and maybe even a little over a year, I've been talking about the possible collapse of the dollar, the petrodollar. We are losing our status as the global reserve currency. And yesterday, we had Brazilian President Lula meeting with Xi Jinping, and they're calling for an end to the dollar's dominance. This is not something that's just popping up. This is a well-orchestrated plan to get the BRICS nations to bail out on the dollar. And here's a follow-up that came out today. I want to thank Nick Mitchell for sending me the link for this article. Very, very interesting. Again, you have confirmation. This came out yesterday. This came out today. It is a very well-orchestrated plan to destroy the dollar. And if that happens, and I do think it will, we are going to lose our status as a world superpower as well. Now, going back to the charts, I want to show you something here. And this is where it all comes into play. If I look at the SPY and I go to a monthly chart, and this is where I'm telling people, this is not my first rodeo. I've been here before. I've seen people get devastated because they believe, oh, we're back into a bull market. We're not back into a bull market. And here's what I'm talking about right here. I'm just going to draw some lines on the chart, just this pattern, where we have an A to B, B to what will be a C, because this is hitting a resistance area. That blue line, this is a monthly chart now, that blue line is the 20-month moving average. I'm not going to change this little drawing that I have here. All I'm going to do is go back in time and show you the similarities. Every single time we've sold off from a high, we've had these bounces where people think, okay, it's over. Let's get right back into the market. Let's buy it up. But take a look at what happens when I go to the left and look at what happened in 2008. Look at that. It's the same pattern, folks. All I did was slide my chart over. I drew from where we are now to where we were in 2008. And if I go back a little bit further, what happened? Oh, look at that in 2000. Same exact sell-off, a bounce. It didn't even come up all the way to that 20-month moving average. And what followed on the downturn from that 20-month moving average was capitulation. There was capitulation in 2000 that lasted for almost 2 years, definitely a year and a half to 2 years. Here was capitulation that lasted just under a year, where we had massive selling after that had turned lower. And what am I expecting? I'm just expecting history to repeat itself. That's all I'm looking at. And if you look at the line after capitulation, where does that bring us? To my forecast of the March 2020 lows across the board. That's why I am not budging on my opinion, because I'm seeing the patterns repeat over and over again, and I don't see anyone really focusing too much on the financial networks. I do not see them focusing too much on risk management. I'm pounding the table on that. Again, you may agree or not agree or completely disagree, but there's nothing wrong with putting a good risk management plan in place. If you're long, protect your downside. If you have profits after being long, you protect your profits. If you're short, you continue to manage risk just like you would on any long position, right? So that's what I have for you this week. I hope you enjoy this. Please like and share. And if you click that notification bell right at the top, you will get notified when this alert goes out. It will go out on Saturday morning, every Saturday morning, unless there's a holiday, at 7 a.m. Eastern Time. Thank you for the comments. Thank you for the questions. I've been doing my best to keep up with that. Stay tuned to Market Rebellion and stay tuned for the video right after this to show you about how you can get access to my 7-point trading checklist. Take care, folks. There's no more damaging formula than to mix emotions with money. Listen, we're made up of emotions. We have fear, we have stress. The trading checklist helps take that all away. And now, wow, take a deep breath, relax, and enjoy the ride. You might be completely foreign to technical analysis. You may not even know what a bullish engulfing candle is or a shooting star. That does not matter. The great thing about what I'm showing you right now is I'm taking 40 years of experience here and I'm breaking it down to 7 points that you can follow through a trading checklist. Look at any stock, any ticker symbol using the 7-point checklist that I have and determine who is in control of that price action. I'm AJ Monte and this is my 7-point trading checklist.